If we can build in a situation where we know we're going to get 5% rates of return, let's say internal rate of return long term, it's not about chasing the big return. It's about making sure that we're operating more efficiently. And if we have a system that can help increase efficiency, then you don't have to worry about chasing those huge returns, right? Because most people think I got to get a 10% return, but they're trying to take a small percentage of their money to accomplish this big return. And because of that, their results flounder, right? But if we could take a bigger percentage of your money, have it operate more safely, and then build an arbitrage with it and build in a 2 to 3% arbitrage on almost everything you do, then that's where good stuff happens, right? Hey, what's going on, cash flow hackers? It is Chris with Life 180. And for this video, I'm going to talk to you about what is arbitrage, why does it matter, and why do I talk about it so much? Now, because if you've been watching a lot of my content, you've probably heard me use this word about a gazillion times. I use it a lot. It's one of my favorite words. It's one of my favorite concepts. And I think the reason it is I also use the term leverage a lot, the importance of leverage, the importance of using other people's money. This is one of the things that I think Dave Ramsey's and the Susie Ormans and whatnots of the world don't really get it and don't really understand, or maybe they think you're just not smart enough to understand the concept and implement it in your life with discipline. I tend to think more of you than that. So let's get into this and we'll go from there. So arbitrage, before I get into anything, let's talk about the definition of arbitrage and talk about, well, I guess there's a couple different definitions that I found when I really looked it up. The best one, believe it or not, that I found was on Wikipedia. And in Wikipedia, it says that the definition of arbitrage, it reads out like this. In economics and finance, arbitrage is the practice of taking advantage of a difference in prices in two or more markets, striking the combination of matching deals to capitalize on the difference, right? So when you think about it, this is why I love whole life insurance so much. Because what we have with a whole life policy is when you save inside of a whole life insurance policy, remember, whole life is never, ever, ever, ever an investment. It is a savings vehicle, right? It's a savings vehicle on steroids, right? Because you're going to have a much better return inside of a whole life policy long-term than a savings account. And the great part about a whole life policy is that we know that in that savings account, let's say it's going to get 4.5 to 5% long-term internal rate of return, right? If we know that that's going to be the case, then we can measure that, right? And when we know and we can have a predictable result, we can then use that as a foundational, like kind of cornerstone to our all of our financial decisions, and all the money can flow through that. Now, the beautiful part is what I know to be true is that too many people chase big returns, right? They get into the market. They think that the best way to save for the future is think 30, 40 years out, buy and hold and save in qualified accounts, defer taxes, do all these different things, put themselves in a situation where they're planning for an environment where they don't understand ultimately the environment and all the variables that they're planning for. And if you don't understand the variables and the environment that you're planning for, you're never going to really be able to build a successful plan to get there, right? And so the cool part about going this route and thinking about arbitrage and why I bring that up is because of the fact that if we can build in a situation where we know we're going to get 5% rates of return, let's say internal rate of return long term, it's not about chasing the big return. It's about making sure that we're operating more efficiently. And if we have a system that can help increase efficiency, then you don't have to worry about chasing those huge returns, right? Because most people think I got to get a 10% return, but they're trying to take a small percentage of their money to accomplish this big return. And because of that, their results flounder, right? But if we could take a bigger percentage of your money, have it operate more safely, and then build an arbitrage with it and build in a 2 to 3% arbitrage on almost everything you do, then that's where good stuff happens, right? So here's the deal. Remember, the definition is earning a spread between two different types of investments, right? And so now, once again, it's not about one thing being an investment and another thing being not an investment, right? In this situation, we're talking about a savings vehicle and then leveraging it for an investment. But here's the deal. This is the ultimate amplifier, because it's an ultimate amplifier and it's an ultimate hedge. That's what arbitrage does. So if we're earning 5% and then I can access money at say 3%, let's say, right? That bakes in a 2% arbitrage, a 2% positive spread, because remember, there's a cost of money always a cost of money. If I spend the money, if I pay cash for something, most people think they avoid interest expense. No, but there's opportunity cost for that, because when I pay cash for a car, right? When I pay cash for that car, I lose the opportunity for that money, that $30,000. If I pay for a $30,000 car, I lose the opportunity for that $30,000 to be able to earn money for me. So yes, I paid cash for the car and I avoided the interest expense that goes along with that car, but I also lost the ability for that $30,000 to earn money for me on a long-term basis, right? And so when it comes down to it, think about it. The arbitrage there in that scenario would say, well, if my car loan was 2% and I could earn 5% on a guaranteed basis, that's 3% arbitrage that I lost out on. And so it's all about financial efficiency, right? That's really what it comes down to. And so for this, from this perspective, I guess, what we're looking at is if we can bake in a 2% arbitrage, and which, by the way, with whole life insurance can do that for you, 100% can do that for you, right? And it's important to understand that, these things are, when you do it the right way, they're predictable, they're guaranteed, they're in place, right? Like, that you can execute predictably on this. One of the things I want to caution everybody to, that if you're thinking about doing this, is that index universal life, a lot of people are out there selling index universal life like it is an alternative, right, where you can build an arbitrage as well. Now, I will say this, you can build an arbitrage on index universal life policies because of the way that they work, because of the fact that you have upside with a cap rate or a participation rate, however the policy is designed. But the bottom line is you can't build in guaranteed arbitrage, and that's the biggest difference. I'm not about building in potential arbitrage, because that leaves you exposed on the other side. Because if we have a cost of money and we have a built-in potential arbitrage, but then it goes poorly in an IUL contract and it performs at 0 and you still have a 4% cost, now you have an extra 4% cost for that loan, right? And so that's important to understand. What I'm talking about is building in guaranteed arbitrage, and that's why whole life is the only product in the world that can do this. And quite frankly, that's why whole life insurance is the only product that works for infinite banking, right? If you think about it, this is a key concept to be able to really understand how infinite banking works, and how you can it's really the power of infinite banking is arbitrage. And when you leverage the power of compounding interest, the power of simple interest that you pay, and you scale that out. I just did a video last week talking about how policy loans work, right? And I went through an example of cars and how you can finance your cars, and showing people how you can have $250,000 extra at retirement if you just went your whole life financing your cars the right way, right? Now, most people in America don't even have $250,000 saved in general. I'm talking about $250,000 extra, taking no extra risk simply by financing your cars in the most efficient way possible, right? And so when it comes down to it, arbitrage is simply the spread of what you're earning, what your cost of money is, right? And so if I can build in that 2% spread, that means if I take that and I want to buy a rental property, I could leverage the money inside of my whole life policy. I can go out and use it as a down payment for a rental property, right? Now, the thing is there's always the cost. When I give up the cost of that money, if I were to pay cash and put it down on that rental property, I'm maybe earning money in the property. It's creating cash flow. It's doing all these things for me. But when you do it this way, it's all the same stuff. You get all the same benefits, but the difference is you're earning 2% net arbitrage, net after expenses, after cost of money, everything all said and told, a net gain of 2% extra on that down payment you're putting on your house. If the house goes up in value, fantastic, you earn even more. If it goes down in value, well, that stinks either way, but no matter what, even if it goes down in value, at least have that 2% extra arbitrage that's kind of hedging it for you to reduce or mitigate your losses, right? That can work that way with trading. It can work that way with investing. It can work that way with real estate. It can work that way with your business. It works that way with everything across the board. This concept of arbitrage works in every facet. So I hope that made sense. If you have any questions, leave them in the comment sections below. Make sure you subscribe, hit that bell. Seriously, engage with me on this. I know this is a confusing concept for a lot of people. It's a big thing to understand, because if you can understand this concept of arbitrage and how to implement arbitrage in your life, you no longer have to chase big returns. We all know the market is cyclical. It goes up slowly, it comes down fast, and there's cycles of everything, right? It goes up and down. You make money when the cycle is going down, when there's blood in the streets, is what Warren Buffett says, right? So in that scenario, we need to be planning for that, and leveraging arbitrage is the way to maximize the safety and the good stable growth on the way up. And it's a way to have liquid accessible capital when the market tanks. That way you're able to capitalize on opportunity that other people are not able to. So once again, leave a comment in the comment section below. Until next video, check out the videos and the playlists that we have available for you here on the end screen. Go out, have a blessed, inspirational week, and we'll talk to you soon. Take care.